Hey everybody, hey traders, Chris Barber here, just after closing bell on Friday, August 8th. Hope everyone had a great trading week. It ended up being exactly what I thought it was going to be, which was a inside week, meaning we have a high from Thursday the 31st, and we have a low from Friday the 1st. And even though price had a rip on Monday, it proceeded to still make highs on Thursday, Friday, but not enough to poach the highs or break the highs, not even test the highs. Next week, major news is going to be U.S. inflation. Is that enough to get the market to go somewhere? If inflation comes in higher than expected, if the headline for yearly CPI or core CPI is higher than expected, or even for PPI for that matter, do we end up maybe testing the highs with more overbought conditions and divergence, and then ultimately to fade? Remember, August, seasonality wise, Europe's on vacation. Uh, Families are still taking vacations in the US. Kids are going back to school in a couple weeks. Things are a little bit slower in August. It's kind of the perfect time to catch the market off guard and catch it by surprise. This year, I suppose the melt up wouldn't be a terrible surprise because it'd be wishful thinking. But somehow, I think that there's a lingering correction in this market that still has to come back to at least test this 50-day moving average, at least pull back and find some previous resistance levels, at least find some dynamic support. So that doesn't make me bearish. It just makes me very patient. I think if this market just stays sideways, I'm going to keep trading and selling highs. I've actually done very well these last few weeks by just selling highs, collecting some income, and trying to sell nice and high with index premium. And the portfolio, just adding cover calls, rolling cover calls, just sticking to really solid like income generating option strategies. But when it comes to what we've been dealing with in 2025 and where we are right now, I do wonder when it comes to the Fed. Okay, rumor mill keeps swirling. Powell's under tremendous amount of pressure. September 17th and onwards, the Fed's looking to cut rates 25 basis points September, 25 basis points in October, and 25 basis points December. Now, what does that do to the bond market? What does that do to U.S. 10-year yields? Okay, let's go to U.S. 10-year. Right now, the last 4 days, 10 years have actually gone back up. We are no longer near these Liberation Day lows. We are not near the markets when we were tanking to the downside in March and April. Just like what happened in 2024, if the Fed cuts by 75 basis points, are we going to see 75 basis points of yields going higher or 75 basis points of yields going lower? That seems to be the one thing that the Trump administration isn't understanding right now, is that the bond market, if we are going to see yields rally or yields raise, up into 4.6, 4.7, 4.8, that's not a good sign. That's going to be the same reason we kind of choked off growth and it's continued to stretch the consumer and stretch businesses where borrowing is going to be even more challenging. If you've heard about this $40 trillion debt bubble, well, that's the world that needs to refinance. And to the tune of about $40 trillion. It's not immediate. It's not just all happening in one deadline, but over the course of 2020 and 2021 and 2022, all post-COVID savings that everyone is able to borrow at cheap money before the rates started to increase in 2022. If you have, 5 to 10 year financing, that's coming due in these next, 6 months, 12 months, 24 months. And that's going to make things really interesting with how the world can refinance $40 trillion worth of debt. Could the can get kicked down the road? Sure. Could fiscal policy continue to outweigh monetary policy? Sure. We have central banks around the world that have been cutting rates all year. The Fed has not done anything. The Fed has gotten a lot of free mileage. We're still at all-time highs. We should be fortunate that we're at all-time highs. And meanwhile, I wonder, with the pressure that Trump is putting on Jerome Powell and potentially even throwing out, who the next Fed chair is going to be or who the front runners are, if the markets start to be a little bit more forward-thinking into believing that, okay, Powell's regime or Powell's tenure is up. What's next for this next Fed chair? Is the Fed going to be ultra dovish or uber dovish? And what does that mean for monetary policy moving forward? Does it even matter? It doesn't really even matter. I don't know. I really don't know. And so the reaction of, okay, August is potentially a lull, and seasonality wise, I don't see the markets going dramatically higher unless this is going to be a melt up into a September like fake out. We melt up into August, September, and then September is a pullback because of the Fed noise, because of maybe the shakeup of all this has been priced in, buy the rumor, sell the news. Market starts seeing that the Fed's cuts already been priced in. Boom, market fails, market falls. Am I bearish in the market? No, I'm not. I'm just looking for dips. Okay, if we start to go higher, 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 I'm still looking for dips to buy. But if we are stretching above 7,000, I'm going to be a little bit bearish going into 2026. So what I'd like to see, and I've been pretty vocal about this, I think that the pullback to the 50-day, pullback to this previous all-time high, pullback into any of these dynamic support levels is a good chance to take some bites and define risk trades into buying some of these dips, get back to these highs, and potentially push higher. So I'd like to see that through August, September, October, and hopefully give us a chance to participate in some dips and pullbacks and not just have a 3.33% correction is the only pullback you get after a bottom in April. I mean, yes, we had a tiny pullback here when there was chaos, right? A little pullback here with a gap, and that was it. Like, that's it. So 3.33 to me is not really a correction. I think that we're still maybe testing highs, testing lows, maybe sideways, but the market probably uses that as a potential base, right? Little pullback, little sideways. Do we get some fake outs here? Then we start to go higher. I could see a play like that working out very well for the rest of the year. If we go higher, 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 I think the market's going to have to pull back. And then we're going to see what this type of pullback is made of. Do we have a dead cat bounce or are we right back to highs again? I don't know. But I will say that inflationary pressures continue and they're persistent. CPI data comes out next week for the US on Tuesday for CPI. What is headline? Is it better than expected? Are we still seeing a sticky inflation level? Do the markets act, negatively to it? I don't know. We'll see. So I think it's a summer lull, and maybe the market stays inside this range again, even though we have a bit more news to maybe trade off of next week. We still have heavy earnings, but U.S. inflation might be enough to maybe poke the highs, but ultimately fail. Maybe fail early and then try to rally the rest of the week. I don't know. But if we don't really make any convincing strides above or below, then it's just still trading the range. It's about a 3.33 right now in the S&P, about 4% in the NASDAQ. I think the NASDAQ might have tried to poke highs. Okay, so here's your high, low in the NASDAQ, and you can see that this week we did actually try to poke those highs. We didn't sustain that breakout, but we got right there towards the Friday's high. So what does that look like for the NASDAQ next week? Well, I think the NASDAQ could, with this tiny little run all the way up here, is this a rising wedge to fall next week and still stay range bound? Sure. So maybe Monday, Tuesday, we'll look at that. Tuesday is CPI data. So keep an eye on that for the NASDAQ and for the S&P. All right, some other assets to discuss. Look, I think that if you're tilted bullish in the markets, I think there's still a lot of upside potential. I think that if we still have sticky inflation, it's good for assets. We have pro-growth, deregulation, fiscal policy that has been a game changer for the markets for the last 4 years, now 5 years. And I think it's taken away some of the clout that monetary policy has always had the last 20, 30 years. So don't underestimate fiscal policy, because now it's not just the US is doing it and spending at deficit type levels or crisis type levels. The world is doing it. China's doing it. Eurozone's doing it. US is doing it. Those animal spirits continue to get lifted. Injecting liquidity into the markets continues to push things higher. We are seeing now that there is a executive order that is allowing 401k holders to start adding real estate and private equity and crypto to their portfolios, to allocations. I don't know if it's immediate, but again, we're talking animal spirits and liquidity into the markets. That's going to continue to push pressures to the upside. That's going to continue to add tailwinds to these markets. So we have more upside potential. If you're long stocks, I think it's still good. If you're long gold, I think it's still good. If you're long silver, I think it's still good. If you're long Bitcoin, I think it's still good. So I'm still long all these things. I'm just trading lots of options in the indexes and my stocks to generate the income, as well as maintain that tilt by also having some downside protection to make sure I'm not caught off guard by something silly, i.e. a 5 to 10% correction that might just be nasty. It might be a nasty pullback. I don't know what the reason for it would be. Nobody does. But we'll see how reflexive the markets are. Okay, so let's take a look at gold and silver and Bitcoin. Gold right here. Still very sideways, the 21 and 50-day moving average, some nice dynamic support. If we just end up going, to retest highs, but coming back down, I like this level at like 32.50. I'd love to see a bit of a deeper pullback to like 31.50. So I'm going to take some bites at 32.50, 31.50, and 30.50 on gold to still stay long. I think gold at $4,000 an ounce is not impossible. I think that silver, to me, silver is still a better trade technically to get up to all-time highs, which are back in 2011 and 1980. If we have a spot price on silver that can hit those levels, that is a run of 25%. To me, measuring a 25% higher gold is kind of crazy because it's already at all-time highs and it's had a much better run. But silver has been playing catch up, and I think there's still plenty more to go in silver because it's not just a precious metal, but it's also a bit of more of an industrial. And I think that gives it more uses. So I'm hoping that poor man's gold here does pretty well. Bitcoin trading at 116. If you're willing to buy the dips, watch the dynamic support and all these moving averages. If we go to highs, I've got symmetry measured at 132. I've got Fibonacci extensions up in the 140s and 150s. Could be really encouraging. And I think this is an interesting momentum train that, after the Fed starts cutting rates and monetary policy kicks back in, I think Bitcoin and gold and silver still look very attractive. Individual stocks, let's go to MAGS and dollar index. MAGS is right back up to highs. A lot of this was led by Apple. Let's take a look at some of those MAG 7. So Apple has had one of the best weeks since 2020, which is insane. Apple finally, playing game, kissing the ring a little bit, and Apple's up one of the best weeks since 2020. You go to Amazon, fighting back and filling the gap in earnings. AVGO still poking all-time highs. Google getting back up to all-time highs. I'm actually surprised with Google up and Apple up and even Amazon that we didn't have more of a run into the S&P this week. Meta still hanging out with that little island gap from earnings. Microsoft has faded since the top here. That's a bit of an exhaustion gap, which I think is being interesting. I still like Microsoft as a buy on dip, but just where, maybe 500, maybe 470 or so. But I think Microsoft's still in the AI race, especially looking pretty favorable. Netflix, nice little bounce off the 100 period moving average. Nvidia, overbought with divergence. My gosh, like technically this thing needs to pull back. I just want to dip to sell some more puts on Nvidia. But we're probably going to have something to give this thing a break. We have earnings on this as well. One thing I could see is another exhaustion gap where we just do nothing and then it just goes pop and then fades back down. We shall see. Okay, Tesla up to 329. I still think it's a nice wedge, but to me, looking pretty promising for this type of structure. If we break those highs, maybe going higher. Tesla in 2025 getting back to all-time highs would be pretty amazing. I'm not gonna lie. I'd love to have a nice little chunk of profit on Tesla this year if it goes back to all-time highs. And that's it for kind of the Mag 7. We can throw in, Berkshire Hathaway. You can throw in some other top 10s, but that's what I'm watching at. Bonds. If we have risk off, we'll probably see the dollar go up. We'll see bonds go up, but we've seen the market still just trying to press highs and stay sideways. I don't think the dollar is necessarily breaking lows. I think the dollar is still range bound. Yields I keep watching closely, and that's how we're at. So, overall, there's a lot of caution, and for good reason. There's a lot of noise. I think that's what traders have to get used to in 2025. If you're not already used to it, there's just a lot of noise. We have some big news next week with U.S. inflation. Does that make the market do anything technically? We're sitting at highs again on the Qs. Are we going to retreat from there? If we're sitting at highs on the SPX or close to them, are we going to retreat from there? Right? So do the Qs go a little bit higher to fade? Does the S&P go up here to fade? We'll find out next week. Maybe Monday is a test of the highs. Tuesday is a fade of the highs. We will find out. I'm going to continue to sell 0 DTE call options and just collect income. It's a pretty good way that I measure out, kind of the highs of the day. Oftentimes they are not hit, and that's a pretty good way to safely make some income, in addition to having some downside protection, waiting and being patient for some of the bigger opportunities for me to allocate some capital. And just, I think that's the hard part. Be patient, be disciplined, don't take silly risks, don't over leverage. I think the market's going to hopefully continue to offer good opportunities and not just go up. I think we go sideways for a little bit longer. I think we possibly have a pullback coming. So let's go to SPX here. I think we have a pullback. A little 3 1/3% pullback is not enough to me. So if we go higher, I'm still a little hesitant to chase that high. So I think a poke, a pullback, maybe 4 or 5%, maybe 5 to 10%. Just give us something dynamic to buy the dip. All right. If the market melts up, cool. I'll enjoy the melt up every step of the way. But if we stretch up to 7,000 with nothing but a 3% pullback after a 25 to 30+% rally since those April lows, I hate to say it, but I'm going to be a little bit more bearish going into that 7,000 high. And bearish to what? Like a short term, maybe a 60-day correction, sure. Maybe the top of the market in a bear market, I don't know, maybe. Right now, it's just there's so many things that are trying to keep this market going and keep going and keep going. But I think a little lull, little pullback would be great, kind of shake out some of the weak hands, and we will see if only the strongest survive. Okay. So, all right, I'll let you go for this weekend. Have a great weekend. Let's come back and do it again next week and grind. I look forward to seeing everybody, and take care. Talk to you soon. Thanks. Bye.